Hello, everyone. Good morning, good afternoon, good evening, depending on which part of the world you're at. Welcome to today's session of the Payment System Broadcast Series. I'm going to allow a couple of seconds for everyone to settle, and we're going to start shortly. Okay, let's start. So once again, welcome to the Payment System Broadcast number 23. Today we have cyber resilience, insights from stress testing. As usual, we're going to have the introduction and housekeeping. I'm going to be in charge of that for the first 5 minutes. Afterwards, we're going to have the main session, which is going to take about 45 minutes. And at the end of this session, we're going to have Q&As. Please remember to send your Q&As in the Q&A widget, which is called Slido at the bottom right corner of your screen. Or if that doesn't work, you can try to do it on the chat. So let's start. Cybersecurity, we all know it's one of the most pressing threats to financial stability. Today, we're going to explore how computer-based simulations can support cyber stress testing exercises, which is obviously something that central banks, regulators, financial market infrastructures, and financial institutions use and prepare for and to withstand cyber incidents. Today, we have three distinguished guests, Tanai Khiaonarong, Kasperi Korpinen, and Emran Islam. In the same order, Tanai is a senior financial expert at the IMF, Kasperi is senior economist in the payment system department at Bank of Finland, and Emran is senior financial sector expert at the IMF. Together, they co-authored a recent IMF working paper titled Using Simulations for Cyber Stress Testing Exercises. Our discussion today will highlight why simulations are particularly relevant in this case, the framework they propose to do this cyber stress testing, the scenarios that they tried and tested, and the implications for cyber resilience in payments and financial infrastructures. So thank you for joining us, Tanai, Kasperi, and Emran. Thank you for joining us. First of all, do you have any disclaimers that you want to start with?
Nope.
I guess not. So let's start with the questions right now. So as usual, as we do in this series of broadcasts, the first question is for you to present yourselves and to share your involvement in this work and what motivated each one of you to develop or to participate in this paper about cyber stress testing. Who wants to start?
Carlos, maybe I can start.
Okay, Tanai, thank you.
Yes, well, good morning, everybody from Washington, D.C. My name is Tanai Khiaonarong. I work at the IMF as a senior financial sector expert in the Financial Supervision and Regulation Division of the Monetary Capital Markets Department. And first of all, I just wanted to thank Dr. Carlos Leon for moderating this session and Anastasia, who's organizing this event. And to FNA in general, for taking an interest in this topic, especially, for Dr. Kimmo Soramaki, who's really has been a pioneer, in my view, in advocating the use of computer-based simulation stress testing, in his earlier days at the Bank of Finland, which I think continues to be a really, a tradition that you have at the Bank of Finland. So for my part, I think maybe I just wanted to share that in terms of my own involvement in the paper, I'd helped and orchestrate the paper, and it was a great privilege for me to have worked with both Kasperi Korpinen and Emran Islam. Kasperi, in my view, is really the expert on stress testing. And Emran himself is a world-renowned expert on cybersecurity. So it was a privilege to work with both gentlemen and orchestrate the study. In my involvement as well as in the paper, helped author the early sections of the paper in designing the scenarios, which I'll talk about later. And in terms of the motivation itself, I think there's several. I think at the fund, we've published the global financial stability report, which I think many of you might have had a chance to look at. One of the key messages was that cybersecurity is a growing concern for macro financial stability. So in this particular paper, we really wanted to, go further and, to assess how bad could it get, if by quantifying some of the risk. At a high level, we would typically look at, the systemic nodes. We try to look at the concentration risk, any potential systemic risk, single points of failure, interdependencies. And I think this all comes together really nicely when you do a simulation, of the whole ecosystem, which we try to attempt in this paper. I think the other motivation, as I mentioned earlier on, was all of the early work that has been done on the simulation front by many central banks. And just to name a few, in Finland, Austria, Denmark, Hungary, in the UK. If you really go back into the history of simulations, I think these are some of the central banks which were, helped pioneer this method, and I think what we're trying to do in this paper was just to continue that tradition, just to revisit this really useful tool in the context of cyber stressing exercises. So with that, I think I'll pass on to my colleagues.
Thank you, Tanai. Kasperi.
Yes, so hi, I'm Kasperi Korpinen from the Bank of Finland, and been working now with the simulator since 2008, and I'm really much engaged in the development of the simulator, specifications of it, and looking after our programming work and kind of some sort of a CTO role in a certain sense, that I look a little bit after the technological development and whether the direction sounds good or so on. So I evaluate the plans in general, and also very happy to have had this opportunity to work with Tanai and Emran as well. It has been very fun and also doing something a bit different for a while with different people. It's always nice. I love it. And yeah, so to come back to this specific exercise, it's my role was more in a technical side, precisely, of course, as being involved with the development of the simulator. So my job was more or less to adapt the new methodology to target services as we perform the exercise with the Finnish component, so the Finnish banks of that are participant to target services, and so that the new simulator as target services is new, so is the new adaptations for the target services as well, and the work was all the time shadowed by actually development work ongoing on the new target services, and this also makes actually this paper the first one that has been made with these new algorithms and the new adaptations in its kind. That of course came with some caveats as well, but let's maybe mention those a bit later on. So I've been contributing to the development of these algorithms and specifying them, but at the same time also taking the automated stress tester into use with the new target services environment, and defining new reports that take into account the specificities of the target 2 data, and which is pretty complex. It's a complex system, so there is a lot of things to do there. Yeah.
Thank you, Kasperi. Emran.
Yeah, sorry. I mean, there's not a lot necessarily I have to say beyond what Tanai and Kasperi have said, but I would say I think a few motivations behind this paper. One, a lot of work has been done around cyber testing, whether it's red team testing, penetration testing, vulnerability scanning, general simulation exercises of a more crisis management type over the last 20, 30, 40 years. In fact, this is not necessarily new. And a lot of those tests have often focused primarily on the cybersecurity of an individual institution, how secure they are, where their control weaknesses are, and what potentially needs to be done to address that. What I think has not necessarily been done as much is trying to use data to actually stress the financial system or ecosystem more broadly to really assess where those potential critical nodes are, and where in certain scenarios, if it crystallizes, those nodes could lead to potential financial instability. And therefore looking at this more from a kind of macro ecosystem perspective. And I think that was really one of the drivers for the paper. And hence, when you look at the kind of policy considerations later we'll discuss, a lot of the focus is about understanding the ecosystem, the kind of interconnectedness of the system, and how a cyber scenario could, in different scenarios, different cases, with different participants and stakeholders, transmit through the system at scale, at propagation, at speed, to trigger financial instability. That was really the driver, I think, and hence why this paper is the start for it.
Thank you, Emran, and thank you, Tanai and Kasperi. The next question is very well related to what Emran just said, which is we all know that the reason to use simulations is to study the impact of stress scenarios in payment systems, which we already know that those payment systems are complex adaptive systems. And let's say the issue or the problem is that those complex adaptive systems cannot be analyzed by other means but simulations. There is no closed form solutions to try to understand what happens when a financial institution is not making a payment from 8 to 9. It's very difficult to do it that way. It's not feasible to do it like that. So, Kasperi, can you describe how the simulation framework that you implemented works? That's the whole idea. I mean, to understand why is that we need this simulation framework to tackle this problem in complex adaptive systems. Kasperi.
Yeah. So basically, the simulator, how it works is I like to always start that it's kind of a real simulator. So it replicates the functionality of real payment systems. So you have the queue mechanisms, you have the liquidities, you use the transactions as input data, and you put all those into the simulator. And then depending, of course, on the system you want to study, you need to adapt a little bit the setup you have in the simulator. So like I said already, that for the target services, it's very complex. So you need a lot of different kind of partial netting algorithms and bilateral algorithms, queue release mechanism, and so on. So you need to really take into consideration. And maybe the latest difficult addition there was the automated liquidity transfers between systems, and so all this adds to the complexity. And if you compare to a pure RTGS system, which is very simple, it's way easier to simulate those and faster also, of course, because precisely they're more simple. So having said that, the methodology here relies on past work, of course, of colleagues like Soramäki and Matti Helqvist and Harri Leinonen and all this that also Emran already mentioned before, and it takes over. And what we notice here that on the overall setup, if the scenarios we are simulating are like operational outages or something, from a practical point of view, the way you simulate it here is the same. So whether it's a cyber attack, if you have an operational outage, whether it's due to a cyber attack or whether it's due to some other event, you might have it kind of similar. The way you model it for the simulation is the same. So to say in short that if we have how we do this in practice, that I take two examples, is that if we have an outage, so payments are postponed, that will be our scenarios 4 and 5. It means that we literally, in the simulation, we postpone those payments to the end of the anomaly, more or less. And in other cases where we have just payments removed totally for a reason or another, cyber attack in this case, we just remove those payments starting from a certain point and ending to a certain point, which is predefined in the scenario, like it's defined by the scenario. So that's more or less the way we do these things. And of course, then we need to also take into consideration which type of payments we are affecting. So if we have automated payments, we have different automation in the system, all that's in the system. So we have the secure release mechanism that handle the queues automatically. And so we keep those running, and then we have certain types like the liquidity transfer, precisely, that they are automated, so they most likely they keep running, so we leave those in the models. And yeah, so hopefully this answers enough the question. It's a
I think it's a good answer, and I think that we're going to get even more elements as we progress with the session. So thank you, Kasperi. Tanai, and it's also related to what Kasperi was mentioning about the scenarios. In the paper, you present 5 cyber stress scenarios, ranging from an attack on a major bank, which is like the typical PFMI type of stress test, to even an insider threat at a central bank. Could you walk us through these scenarios and why you chose them as plausible yet extreme tests for this exercise?
Thank you for the question, Carlos. And when we were exploring the different type of scenarios that could unfold for a cyber attack, we got back to the question of how bad could it get, and what could be the macro financial impact, right, of a cyber attack. So therefore, we kind of interpreted extreme but plausible by focusing on the systemic nodes. I think Emran also mentioned about the critical nodes in the financial system. So we came out with these scenarios, which I'll quickly walk through just to give an overview. The scenario 1, it's more of a baseline. So it's kind of a benchmark scenario where the financial ecosystem operates normally. Liquidity flows normally. There's no changes to the liquidity flows like you would normally expect in a typical business day. So that's scenario 1, which we use as a benchmark. Then scenario 2, it's refers to a systemically important financial institution being targeted by cyber criminals, right? So in this scenario, in any typical jurisdiction, you might look at, let's say, the largest financial institution in a given jurisdiction is targeted, okay? And the typical scenario would be, a compromise to the endpoint security. Maybe one of the payment security controls was compromised. So that was the first scenario. A big bank was hit, okay? And this could be in any jurisdiction, okay? Not just like the one that we use in the paper. In scenario 3, we envisage, a critical service provider to the financial was hit and experiences an outage, okay? So in this scenario, we assume that 5 of the largest banks in the jurisdiction, they use this common CSP, the critical service provider, for data processing, information systems, processing. They also happen to rely, their core banking activities also relies on this common CSP. So that was the assumption And so we move on to the fourth scenario. The fourth scenario was quite a bit tricky because it refers to a central bank being compromised by an insider threat. So this is so I think in a typical jurisdiction, when you speak to central banks would be very confident that they are well protected. You know, whether it's a physical security or logical securities, is heavily fortified, like Fort Knox, right? So it's difficult to get into a central bank in the first place because it's well protected. But the assumption we have here is an insider threat. You know, that it could happen to a, let's say one of the former central bank employee, which might have been a disgruntled employee who left the central bank. They might have access to the system, a critical system like the real-time gross settlement system, and therefore that is the source of the insider threat. When we were thinking about this scenario, there's a lot of literature on insider threats. But for central banks, I think it's the closest that you could come to is a scenario whereby there has been a theft of currency notes within a central bank by central banks staff themselves. I think you have those precedent cases more in the physical world, but in the digital world, we're talking about maybe a current or former staff getting access to a system, access to critical systems, and the security controls were not tight as expected. Okay, so that was the hard one. So on the central bank, on the fifth and last scenario we explored in the paper was a systemically important financial infrastructure faces an advanced persistent threat. I think in the last scenario, we wanted to explore a bit further on, the implications of an FMI that provides cross-border and multi-currency settlement services. We wanted to explore themes like, let's say what happens if there is like time zone differences involved as one of the assumptions where, clearing settlement happens in different time zones. Some of the systems operate at different hours. We wanted to explore that. So we built that into the final scenario. So in each scenario, we kind of like made assumptions of, a number of assumptions which could be found, the details could be found in the paper that was shared, in the chat room, that, there might be some anomalies that were introduced in terms of, let's say, anomalies in the liquidity flows, the outages, the systems was out for X hours. And we try to keep these outages above 2 hours, okay? Because usually the international standard in the PFMI is like, recovery time objective of 2 hours, right? So all the assumptions we go above 2 hours, right? But having said that, when we actually presented some of these early findings in many of the events, whether in Finland or in the US, where we run like some cyber workshops, I think the feedback was that is this extreme enough? Okay, I think are these scenarios extreme enough? I think when you look at whether it's extreme or not, I think you could go further, which we'll discuss later on. Like, I think the simulator is so flexible in a way that to build in more extreme scenarios, you can, always explore longer outage hours, more impact on the liquidity flows, and you could.
Sorry.
Yeah, thank you.
Okay, I thought I lost you, but that was okay. Thank you, Tanai. Kasperi, which of these scenarios produce the most severe stress tests in your simulations?
Yeah, so first of all, that I would say that none of these was in practice at the end very, very severe, but in the terms of direct effects is definitely, of course, scenarios where you remove payments altogether. So that would be then the one major bank failing and also the CSP case, and that actually comes directly from the fact that payments were removed. And in the internal attack case and the external ancillary system case, the reason why the outcome is not that bad is because the payments are only delayed, and that comes at the same time to the outcome actually from the analysis that in these cases the payment system, if it's allowed to run normally and the payments stay in the queues and or are brought to the queues later on normally, the system is able to recover very well. And yeah, but still what we noticed is that in none of the cases we had much systemic effects coming out. So that can be partly due to excess liquidity, but I think also because of netting effects that in the CSP case, the banks that were taken out, they are very interconnected between themselves, so they are not leaving open positions that much towards each other, because they in a certain sense their reciprocal payments are taken out, and those are the most important. So that's why it's not affecting that much their liquidity positions at the end of the day. And also most of the payments most likely are going earlier in the day as well. Yeah.
Perhaps one question that I have, and thank you, Kasperi, for that answer, is what was the criteria to define a major bank? Is it about size? Is it about connectedness? Is it about substitutability? I mean, to bring like those terms that the BIS has coined for systemic importance. What was the criteria here?
That was payment size, like amount of payments. Yeah.
Okay, that's good to know. So going forward, Kasperi, the methodology relies heavily on transaction level data and the Bank of Finland's payment and settlement simulator. Could you explain how these simulations replicate payment system behavior and why this approach is particularly valuable for cyber preparedness?
Yeah. So I think the value of simulating a payment system grows with the complexity of the payment system itself. So what I mean with this is that the more you have specific risk management features, liquidity saving mechanism or gridlock mechanism in the system, the more the simulations start to have meaning in that sense from the replication perspective. And so in practice, we know that T2 services is a complex system. So it's first of all, the core is about two components. So you have the liquidity management system and the RTGS, and they have a liquidity transfer relationship between each other, and which we have also modeled. And then we have modeled, of course, all the queue release mechanisms and the netting algorithm and all those precisely to model this complex relationship between the CLM and the RTGS, and the RTGS with the ancillary systems and all the cycles, the bilateral limits, credit limits, intraday credit limits, and all these different rules, opening hours, closing hours, of course, and all the ways that you can bypass FIFO. And yeah, so we have implemented all of those in this model. So it's fairly complicated, you can guess. Yeah,
that's true. Emran, anything to add here?
Yeah, I mean, I think from a cyber preparedness perspective, what was useful here and what would be useful within any context is that when you kind of set out certain scenarios and you try and simulate different scenarios, whether it's a large value payment system, whether it's a critical service provider, whether it's a number of banks or one bank, whether it's ancillary systems that kind of connect into the large value payment system, whether it's the FX system, what you do by going through that process and that methodology is actually deepen your understanding of how your financial system works. So in essence, it's what Kasperi said, in some cases, certain models for some payment systems like retail would be that they may be a deferred net settlement system, or they may be instant, for example, and instant meaning, real time. So the cycles of when they settle, you will need to understand those kind of arrangements and complexities. There is also the case that there is, generally with payment systems, the way it works is it's quite logical, quite well kind of grounded, and in many ways stable. For example, that there are certain days in the year where there will be a large increase in volume, for example, because it may be government payments, it may be tax due on these days, it may be salary payments. So you begin over time in any system to understand the behavior. You begin to understand the patterns, and that therefore allows you to also potentially identify anomalies. The reason why I say this is because going through this process, building certain scenarios based on existing knowledge of how the system works, allows you to prepare for that scenario where something happens. So we, for example, will be better prepared if we understood a cyber incident or an outage at this given moment with this particular system on a day of this type of a day can have this impact, and therefore we need to be prepared in this way. This is the kind of playbook we need. These are the contingency arrangements we need, and we need to be well versed as operator, as supervisor, as overseer to be able to manage that. And I think that's, for me, what I felt was quite useful is going and undertaking this process deepens our understanding of the system, the patterns, the stakeholders, and how they kind of connect. And therefore, as a result, the impact in a broad range of extreme but plausible scenarios, and therefore, consequently, how do we best prepare for it in advance?
That's great, Emran. And I think that I will chip in with a comment about what we do at FNA regarding stress testing. And we work on that subject a lot also for central banks and financial market infrastructures. And what you just said is exactly the point that we always try to do when working with this kind of users, which is you cannot understand the system that you cannot simulate. If you simulate it, you will be able to understand which are like what happens in the inputs and go to the outputs, because in the middle there is something which is very difficult, as Kasperi also mentioned, is very complex. So it's very difficult to simulate in a straightforward way. So you need to simulate, and this understanding will help obviously financial authorities to prepare. They will know what happens if Bank A has a stress event, whatever, a cyber attack, or it's unable to make a payment from 9 to 10, we will know what is the systemic footprint of that financial institution and whether the central bank should do something or not, or if there is something that should be done. So that's exactly the point about understanding. Otherwise, what we don't understand, we cannot safeguard it. So that's the whole point. So I'm very happy with that answer, Emran. Thank you.
Yeah, I could precisely add to that. That's indeed the case, and I think particularly it's a very good tool to quantify the risks, to get a grasp on how high and how low or how high the risk can be, like on a participant level in different scenarios, and then at the same time to kind of get a grasp on that and get a priority for the scenarios and the types of scenarios, and not forgetting that as we are using the whole transaction data there as input data and we are running the payment flows, it means we are automatically incorporating all the network effects of the payment network into the results. And I think that's one of the additions that you get from this methodology.
That's true, Kasperi. Thank you. Going to the next question, it's about liquidity. Liquidity stress emerged as a key vulnerability for the financial system, particularly in those scenarios involving a critical service provider or multiple banks. Emran and Kasperi, Could you elaborate on these findings and what they reveal about systemic interdependence in modern payment systems, which is what, Kasperi, you already started talking about?
Kasperi, do you want to kick off, or I can start if you want?
Yeah, please start. Yeah.
Yeah, I mean, I think it's really, again, to kind of probably reiterate what we said was my instinct when we first did this was that of the 5 scenarios, my feeling was that the outage at the large value payment system would have the most significant impact. And that's why it was surprising when actually the stress on the bank or on the critical service provider, which has 5 connected banks, actually showed the biggest stress. Then when I thought about this, I realized actually there is a logic, and it does make sense why that was the case. And the reason being is when you have a centralized payment system, like the large value payment system, in essence, you are very much in control of it. So what comes in, what goes out, you can manage that. You can micromanage that accordingly. And you have certain mechanisms and certain controls as an operator to be able to manage that system when these kind of scenarios occur. What you don't necessarily have grasp of is other institutions who are part of the ecosystem. So if you have a multitude of other banks, if you have them dependent on a third-party provider, more and more these are entities that exist outside of your sphere of control. And therefore the dependency then is on them to know how they should manage their liquidity, on how they interact with their providers or with peer banks with whom they are actually doing interbank payments and transactions. And they don't necessarily have that full visibility. They don't have that centralized facility to see the macro impact of a scenario. And so that was quite interesting in terms of really accentuating this point that the financial system is an actual ecosystem of system interdependencies. And the more we do not deeply understand at a systemic level how they interconnect, the more we put ourselves in that position, perhaps, where we are not able to manage and control the spillover effect. So it just really, for me, highlighted that the liquidity stress that comes from other entities that are not necessarily centralized and managed by one operator, we have a dependency that they know what they're doing and they are taking the right steps and the right protocols, which therefore just, again, when it comes to the next session question where we discuss the policy, really highlights the need for an ecosystem approach to managing potential systemic cyber incidents, where everyone knows by playbook what are the steps they need to take, what are the kind of monitoring that they need to undertake, what are the steps they need to engage in to reduce the potential liquidity stress that could arise in a stress scenario.
Thank you, Emran. Kasperi, you're going to add something to that?
Yes, very little. That indeed so, and the methodology allows you to get these impact vectors on a participant level, related like risk impact vectors on participant level related to different scenarios, and so we can kind of get a grasp on how big these problems can be, and in different situations, and indeed sometimes you might face things that you do not expect due to these subsequent contagion effects in the network.
Thank you, Kasperi. Something that I would like to add is in our experience at FNA, we have a user of our stress testing solution, and what they do is daily, they run a stress test for each and every one of the participants of the system. So they build like a distribution of systemic footprint. So that's exactly that. I mean, it's very difficult for you to know exactly which is the financial institution that is going to be the lowest and the highest stress or systemic footprint. So by testing all of them, you'll have this distribution, and you will know what is like the mass of the stress test effect, but also have details, especially the right tail is the one that all supervisors or overseers are more interested in. So it's also about having like the ability of measuring the stress test for everyone quickly, flexibly. So that helps to understand a lot what is happening. So that goes into what you mentioned, Emran and Kasperi. So going forward, because we're only have 20 minutes left, preparedness. Preparedness is the third step in your framework. Emran, could you share what best practices, such as cyber incident response and recovery frameworks, are most effective in strengthening resilience across both individual institutions and the financial ecosystem as a whole?
Yeah, absolutely. There are 4 dimensions that we have tried to bring out through this paper in terms of the spectrum of steps that are required for preparedness. The first principle or first step is that every financial market infrastructure or financial institution, whether public or private, because both are subject to potential cyber attacks and incidents, must have a robust and effective and comprehensive cyber incident response and recovery framework. We do here in the paper touch on the paper from the Financial Stability Board that was published in October 2020 as a good document to look at. But the essence of that is that what any institution needs is, at the centerpiece in this framework, strong governance. So the board and the senior management really need to understand that a cyber incident is something that is not potentially going to happen, but at some point will happen. And therefore, they need to know what their role and responsibility is, and they need to take ownership of this. Now, with that governance, then comes a number of different phases and stages. They need to ensure that the institution or the entity is prepared before an incident occurs, during an incident, and after an incident. The kind of before an incident occurs, they really need to ensure that firstly, they plan and they prepare for it, and they have the right improvement processes in place to learn from events and incidents and then put it through so that going forward, they're well drilled to deal with upcoming incidents. Then there is the during an incident. What do we do? The during an incident is very much about, firstly, do we have the right capabilities to triage this incident? What exactly is it? i.e. analysis. Then be able to develop the right mitigation strategy to lead to restoring and recovering the system, but doing so in a way which is safe for the system as a whole. And finally, what do you do after an incident? Here, this is about the lessons you learned from what occurred, the root cause analysis, and therefore what are the improvement measures you need to put in place. What kind of governs all of this, whether it's the before, the during, or the after, is having very strong coordination and communication protocols in place. So that's kind of the overarching framework. And then, you go into each component of that, and it's quite detailed. The first principle of having this is really important for us because that puts you in the best place to be able to manage an incident when it occurs. If you're not able to do that, you're effectively planning to fail, right? The second principle that we highlight in our paper is what we refer to as ecosystem resilience. This is very much predicated on the fact that a financial market infrastructure, by definition, is the central hub of a system. And given how interconnected it is to participants, other types of FMIs, ancillary systems, it is part of a much bigger ecosystem, which is interdependent, digitalized, interconnected, very much an operational network. So our view is that it is essential that we build the resilience of the ecosystem as a whole. And that effectively done through a number of different steps. So firstly, understanding how the ecosystem is connected. So mapping that system so we can identify those critical nodes. Secondly, having strong strategic planning and collaboration in place. So putting in the right governance structures between the market participants, the FMIs, banks, and the authorities, and the collective structures that puts in place how you collectively manage systemic risk. If an incident occurs, who do you call? Who do you inform? What are the kind of playbooks you need? How do we collaborate? How do we coordinate collectively? And that also leads to, how do we therefore manage all the different stakeholders? And how do we then finally, as an ecosystem, build response and recovery? And that means, developing those crisis management protocols, putting in operational controls, conducting market-wide exercising and stress testing, and so on. The third principle is around what we refer to as situational awareness. This is very important. Why? Because a cyber incident is unique in its characteristics. Unlike an operational incident, a cyber incident could potentially be coming from an adversary, a threat actor who is targeting you. And in that scenario, you are in a very complex arrangement because you don't know when they're going to do it. You don't know why they're doing it. You don't know how they're doing it. And you have to respond in real time to that scenario in a way which is safe for the ecosystem as a whole. That therefore makes dealing with a cyber incident that much more complex and that much more difficult. So here what we stress is situational awareness, which is let us understand as a collective what our threat landscape is, who is targeting us, why are they doing it, and what is their modus operandi. And that then puts us in a better position to be able to prepare against it, detect, respond, recover from it. And a lot of that means also not only getting an understanding of the threat landscape, but then also sharing information with our peer group. So the critical service provider in this scenario that we had, that had 5 banks connected to it, suffers an incident. Informing all of the participants of what they have seen on their network, what the threat actor is doing, is valuable information for everyone else at that moment in real time to prevent that occurring on their systems. So information sharing is essential. And finally, incident reporting. If an incident occurs, you must inform your regulator, your supervisor, with immediacy. Why? Because this becomes potentially systemic, and then the role of the authorities kicks in. And then the final principle is what we call the authorities response framework. And here it's very important because in any given domestic financial system, you will have a multitude of different potential stakeholders and authorities: a central bank, a supervisor, insurance supervisor, security supervisor, national cybersecurity center, etc., etc. If an incident is systemic, it might spill over. And that is when all of the authorities need to engage, need to be informed, need to have standard protocols and clarity on what their role and responsibility is to intervene should they need to do that. And therefore having an authorities response framework predicated on clear understanding of what is a systemic incident, who needs to call who needs to take what action, who has the mandate to do what, and what the playbook is, that is very important. So these are the 4 principles that we set out in this paper that we think are really key to be prepared as best as possible.
And that's a great insight for everyone who reads the paper or is attending the session today. Thank you, Emran. We have 2 questions and we have only 10 minutes left, so let's do it a little bit quicker. So we leave space for 1 or 2 questions from the audience. So the first one goes to Kasperi, which is, we all know that these kind of simulation models are strongly dependent on the design features of the simulation. And perhaps one of those things that we always get questions about is about how the participants react to stress events, which could come in the form of not doing at all, not reacting, or introducing reaction functions, or even going to agent-based modeling. Kasperi, is this something worth exploring? Kasperi, you're on mute. Kasperi?
Yes, I think those are very important aspects in the analysis, and there are different layers we need to take into account. So first is already in the scenario design phase. So we already know that there are some aspects that we need to take already into consideration when we build the scenario. So how long we can assume that it will take to participants to react to an anomaly and put payments back. So initially, we already have a little bit of assumptions on the behaviors already in the normal baseline scenarios we make. Then it becomes trickier, and we don't know exactly whether some key people are eating their lunch, for example, and so we have a lot of random life happens there, and we have random reactions that will affect the outcomes as well, and we don't know exactly what will be each participant's reaction. But I will continue on that. But meanwhile, I want to mention our liquidity deterioration indicators, because in those we try to, that's why we have like the minimum liquidity deterioration and the maximum. And there we have this bandwidth, and the maximum liquidity deterioration means in the scenarios that what will be the outcome on the liquidity at the end of day, the change at the end of day, how much the liquidity positions are deteriorated due to the scenarios if participants are not able to react to the problem and will take the hit in full, just as the simulation suggests, if things are not changed. So that means we don't know how much collateral necessarily a participant has. So we know the credit line, intraday credit limit probably, but we don't necessarily know how much there is more collateral behind the high quality liquid assets. We actually wrote a paper on this in 2017 with Tatu, where we launched this thing and analyzed the liquidity risk, counterparty risk in payment systems. And that's why we define this range where the liquidity risk we can suspect to vary, like more or less. And the minimum liquidity level is reflecting the level that if other participants are able to react and counter the stress, and all the secondary systemic effects are taken care of, so there will be no systemic effects. So that gives you this bandwidth where we can expect the liquidity pressure to move. And I think that's one attempt to answer the unknown, let's put it that way. And secondary thing is that the simulator does have some rudimentary agent-based capabilities that have been kind of prototyped, but they have not been developed very deeply or to a very, let's say, great level or something like that. But there is something to work with if wanted. But I think here what is important, and maybe this goes more for Emran to answer, is precisely all those rules that you have participant rules, whether you can mitigate the behavioral unknown by preparing precisely this, the audience, the participants, to these scenarios beforehand, and apply some prealable rules of conduct in certain situation, how how do you say, you inform the participants on the issues, all these trust things on the system. And maybe the system design itself also has a role there, whether the people will trust the operators of the system more. But maybe, Emran, you can evaluate this.
I mean, I'm conscious of time, so I won't say too much, but I think Kasperi is exactly right that the unique thing about payment systems is that you have, by definition, system and participant rules that the payment system operator sets. So one of the useful things is that as we kind of set out a number of playbook scenarios, how we organize some of those system rules and system designs and adapt them to different possible scenarios is something that we could explore going forward. And the reason why is because the reason of having a system rule is to, as much as possible, ensure that there is a stability in behavior. And there is a kind of or a mitigation of risk. That is by definition why we have in the PFMI system rules for participants. So being able to kind of elaborate on that, and little things such as if you have an ancillary system that is like an instant retail payment system, having pre-funding in place, having net sender caps or hard debit caps, for example, understanding when those cycles are meant to settle and how you might be able to move and prolong and move one settlement cycle to the next or the next and enforce certain debit caps or net sender caps. These are things that can be thought about and explored based on different scenarios and then integrated into potential rules for this actual payment system operator. I think that's in terms of the future where we need to go in terms of just thinking a little bit more organically, a little bit more innovatively about these kind of scenarios and how we can more micromanage the risk or micro mitigate the risk, if that makes sense.
Thank you, Emran. And you just mentioned the topic of the last question, which is the future. Looking forward, based on the design features of your modeling approach, the scenarios that you selected and the outcomes, which challenges remain for the industry and the academy to address? And something that I would like to add, I mean, because we're not going to have a time for the question from the audience, is I want to also I will ask you to consider two things. First, cross-border, and second, central bank role in this looking forward. Hopefully we can do it in 3 minutes, 1 minute each. Who wants to go first?
Tanai, I think it should be you.
Yeah, I'm glad to respond to that. So Carlos, I think in my view, I think it comes back to the question of what could be possible extreme but possible scenarios, right? I think when we look at this exercise that we've done, I think there's room to explore further 4 areas. One is like lengthier outages, for example, multi-days or even weeks, as evidence in some recent incidents, right, that have been experienced by some FMIs. Second is liquidity constraints. I think Kasperi mentioned that, a scenario of perhaps like collateral deterioration and how would that affect liquidity supply to, in the system. Third is like intraday exposures. What we've really dealt with in this paper was intraday, but with intraday exposures would arise from, let's say, time zone differences, right? For example, a foreign exchange settlement transaction that happens across, let's say, between the Asian time zone and the Western Hemisphere time zone. That's another area. And finally, the scenarios focusing on cross-sector. You have payments, you have capital markets. Something could go wrong in the capital markets, and something could go wrong in the power sector or even the telecom sector that would have impact the payment sector. So the role of the central bank, I think there's a lot of potential. The central bank has the central banks have a role as an FMI overseer and operator, and they sit on. Central banks have access to a lot of rich data that could be used in simulation. So this is a really great potential for central banks to continue this work on this frontier. I'll just stop there and maybe Kasperi and Emran.
Who wants to go first?
Kasperi, I'll go 30 seconds. I'm happy to go because I'm conscious of time. From my perspective, 2 things. Number one, I would like to see this paper and the general policy considerations to be actually used as a method to assess the readiness and the preparedness of a particular country. So basically, in essence, I'd like going forward for us to get to a stage where certain financial authorities in a country may actually do these kind of stress tests on themselves using their transactional data because they have access to it. And then based on that, be able to then evaluate how prepared are we? So the cyber incident response framework, the ecosystem resilience, the situational awareness, and our authorities response framework. Do we have these in place? Are they effective? Are they robust? And if we applied them against this scenario or this scenario, how would we measure against that? Would we be prepared? And if not, where are the holes and how do we fix that? I think that would be useful in terms of us using this as a means of evaluating ecosystem resilience rather than our focal point for so long, which is looking at the cybersecurity of an individual micro institution. Secondly, you mentioned cross-border. I think in the first instance, doing this on a domestic level is easier and useful. But I think for sure going forward, we then need to mature this to be able to do this on cross-border FMIs, cross-border financial sector participants, to then also see how on a cross-authority level, we can manage the ecosystem resilience, how authorities are on different time zones in different mandates and countries, how do they and how would they manage this from spilling over cross border? And I think that would be step 2. Step 1 is let's do it firstly domestically, then look at it as cross border. Done. Sorry.
Thank you, Emran. Kasperi, you have like 10 seconds.
Okay, so I'll pick up on the cross-border aspect. That of course one challenge there is going to be the data to get that one. In the euro area, we have kind of experience of the cross-border between the euro countries. We are able to observe all the data. So inside euro area, we can do cross-border analysis, or every analysis we do is actually automatically a cross-border analysis, more or less. And but then if we go beyond that, it's going to be more difficult to get the data all together. So
good luck. Thank you, Kasperi. Thank you, Kasperi. Thank you, Tanai. Thank you, Emran. This is the end of the Payment System broadcast number 23. And talking about cross-border, let me tell you that we're going to have a very interesting conversation with CLS and Cambridge and the University of Cambridge, in which we're going to talk about the myths in post-trade wholesale FX transactions. So that's something that is going to happen in October 23rd, as I already mentioned, and I hope to see you there. Once again, thank you everyone for joining. Thank you, Tanai, Kasperi, and Emran for joining us today. Very interesting conversation. Thank you, everyone.
Thank you,
Thank you
Carlos.
for having us.